They told us silver was yesterday's story, an industrial relic nobody serious cared about. Then, quietly, something changed. Towers of contracts grew on paper markets while the real metal vanished from sight. A single bank moved silently, inching metal into vaults for years. Nobody noticed at first, but when a market built on promises faces a shortage of things that are actually deliverable, chaos doesn't whisper. It detonates. Imagine standing in a lab where every device needs a tiny sliver of silver to work. Solar cells, 5G racks, medical gear, while mines cough up less and less. Imagine above-ground stockpiles shrinking as central banks print more money to paper over the cracks. Now imagine the exchange that lets traders swap pieces of paper goes dark for 10 hours, and the price spikes into a new orbit. That spike is not an accident. It's the sound of a mismatch between paper promises and metal reality. Today, the countdown is real. Policy meetings drained inventories and vaults that may no longer be available. If deliverable metal becomes the currency of truth, everything priced by paper could reprice overnight. This is not a theory, it's a pattern. And history shows what happens when the squeeze finds its fuse. Decide now, watch, or be surprised later. They built a market that looked stable. On the surface, everything appeared orderly. Underneath, the architecture was paper. After 1980, regulators and exchanges reworked how silver traded. New futures and unbacked contracts proliferated. A paper marketplace grew far larger than the physical metal it purported to represent. Traders could buy and sell claims. Few ever asked for delivery. That mismatch is the heart of the setup. Paper promises multiplied. Physical ounces did not. Industry analysts now call it fragile. They point to record industrial demand. Solar arrays, EVs, 5G gear, all need silver. Global industrial consumption hit new highs in 2024.
Larger than the physical metal it purported to represent. Traders could buy and sell claims. Few ever asked for delivery. That mismatch is the heart of the setup. Paper promises multiplied. Physical ounces did not. Industry analysts now call it fragile. They point to record industrial demand. Solar, arrays, EVs, 5G gear, all need silver. Global industrial consumption hit new highs in 2024. Meanwhile, the mines did not keep pace. World mine output has not expanded proportionally. USGS data shows mine production barely budged, even declining in some years. That gap creates a ledger problem. A contract can promise metal, but the metal may not be there when demanded. Enter the exchanges. COMEX and its futures became the price engine. They offered instant liquidity. Paper contracts set the global quote. Liquidity felt safe. But liquidity on paper is not the same as metal in a vault. History warns us what happens next. The Hunt brothers tried to own the metal in 1979. Their buildup pushed prices to extremes. Regulators changed the rules to stop them. After that, the system doubled down on paper. Derivatives grew, open interest climbed, leverage inflated. It all looked efficient, but it also amplified risk. Today, the signals are subtle and ominous. Exchanges still set the price, but physical inventories tell a different story. Dealers report rising premiums. Vaults report shifts from registered to eligible status. That reduces deliverable supply, and the infrastructure has its own failure points. A recent CME outage halted trading for hours. During that blackout, price behaved like a live wire. This is the paradox of the setup. A market built for stability can hide fragility. Paper soothes volatility till it cannot. Then the ledger becomes a countdown. What looks like normal trading becomes a pressure cooker. Every new contract adds another promise. Every ounce consumed by industry tightens the screw. And the next time something breaks, it may not be a short-lived wobble. We are watching that subtle pressure tonight. The clock ticks toward policy meetings, vault movements whisper, and the paper market keeps growing. If there is nowhere left to hide the gap between promise and metal, what happens when promises demand the real thing? The answer is not gentle, and the fuse is already warm. The expansion wasn't sudden. It was quiet, incremental, barely visible unless you were watching the right numbers. After the system stabilized post-1980, something began to grow beneath the surface. derivatives, options, futures, synthetic silver. Contracts so layered and complex that only a handful of institutions truly understood their scale. Every year, more traders joined the paper market. Every year, fewer demanded physical delivery, and every year, the leverage climbed. Paper became the dominant language of silver. Buy 10,000 ounces with a fraction of the cost. Sell claims you didn't own. Roll positions instead of settling them. It was efficient, cheap, fast, and dangerous. This is where the expansion turned into distortion. When a contract multiplies faster than the thing it represents, the market becomes abstract, disconnected, a hologram of value, floating above a shrinking foundation of metal. Meanwhile, the world kept changing. Economies digitized. Energy grids modernized. Governments borrowed more, printed more, spent more, and silver quietly became the metal of everything new. Solar fields expanded across continents. Electric vehicles surged. 5G towers rose. Hospitals needed more precision components. Defense needed more electronics. Industries needed more metal than mines could produce. But the market price didn't reflect that urgency. Instead, the expanding paper market acted as a buffer, a shock absorber, lid. Every time physical demand tightened, paper liquidity smoothed the waves. Every time inventories shrank, contracts filled the gap. Every time premiums rose, futures calmed the quote. The illusion of abundance stayed alive. But this expansion came with a hidden consequence. When liquidity rises far faster than supply, volatility gathers like static. Invisible at first, then impossible to ignore. You can't keep adding weight to an overloaded shelf forever. You can't keep promising ounces that may not exist. You can't keep allowing financial engineering to outrun geological limits. This is the real expansion, not just of contracts, but of fragility. A bubble made not of price, but of expectations. And bubbles like that don't burst slowly. They snap. The only question is what snaps first. The vault inventories, the delivery system, the exchange rules, or investor confidence itself. Because once confidence cracks, silver doesn't reprice gradually. It reprices violently, instantly, irreversibly, and the world wakes up to a market much smaller and much tighter than anyone believed. The industrial squeeze didn't arrive with fireworks. It crept in through factories, through laboratories, through assembly lines humming across the world. Silver's greatest strength became its greatest vulnerability. It isn't just a store of value, it's a necessity. No other metal on Earth conducts electricity better. None reflects light more efficiently. None combines antimicrobial, thermal, and electronic properties the way silver does, and industries took full advantage. Solar manufacturers consumed millions of ounces a year. Early EVs used grams of silver. Then automakers doubled it, tripled it. Modern cars are rolling circuit boards. Each one drinks silver like water. 5G infrastructure towers, antennas, semiconductors devours silver. Medical devices rely on it. Defense technology depends on it. Even your smartphone carries a tiny piece of the silver puzzle. Demand soared. Supply did not. Mines struggled, or grades fell. Costs rose. Environmental restrictions tightened. New discoveries slowed. Old mines exhausted themselves. This created a structural deficit, a years-long shortfall where consumption permanently outran production. Above-ground stockpiles started draining. Inventories dipped. Refiners ran hotter. Mints reported delays and shortages. Premiums on physical bars climbed. And something else happened. A shift in mindset. For the first time in decades, industrial buyers began worrying about future supply. Some started locking in long-term agreements. Some quietly accumulated reserves. Some expanded recycling programs not to save money, but to secure metal. When industrial buyers fear scarcity, investors should pay attention. Because industry buys out of need, not speculation. If factories can't get silver, products stop, revenues fall, entire sectors freeze. Price becomes irrelevant when survival is at stake. That's how shortages become crises. That's how a quiet industrial squeeze becomes a financial event. That's how a minor supply imbalance becomes a global chain reaction. The market today is balanced on a razor. Rising demand on one side, strained supply on the other. And a vast inflated paper system hanging in between. The squeeze isn't coming. It's already here. Most people won't notice it until the symptoms hit the mainstream. Supply delays, sudden price jumps, premium spikes, delivery failures, emergency contracts. By then, the industrial world will already be competing with investors for the same shrinking pool of real metal. And in that kind of battle, paper doesn't stand a chance. This is the part no one talks about loudly. Because institutions don't announce their intentions, they reveal them through silence and through movement in the vaults. For years, major custodians, banks, funds, institutional traders have been quietly repositioning silver, not selling it, not distributing it, but shifting it from registered to eligible, from deliverable to non-deliverable, from public inventory to private custody. On paper, nothing seems suspicious. Eligible metal still exists, still sits in the vaults, but it's no longer available to satisfy delivery requests. It's the financial equivalent of turning liquid metal into untouchable metal. And when large institutions do this at scale, the message is clear. They want control. They want insulation. They want the metal locked away from market pressure. This isn't retail stacking. This isn't casual demand. This is strategic accumulation. Institutions don't hoard silver for fun. They hoard it for advantage. They know the limits of supply. They see the drain in inventories. They understand the leverage in paper markets. They monitor global industrial consumption, and they position accordingly. Some banks accumulated ounces so large they became systemically important. Some funds rolled paper profits into physical metal. Some moved bars into long-term hold classifications. Every ton relocated reduces available supply. Every shift into eligible tightens the noose on deliverable inventory. Every private transfer pushes the market closer to imbalance. And here's the part most people miss. Institutions hoard before crises, not during them. By the time headlines announce shortages, it's already too late. The vaults are already drained, the shelves already bare, the deals already signed. The accumulation phase is silent. The realization phase is loud. Right now, we are deep in the silent phase. Large players are positioning. Metal is moving. Inventory classifications are shifting. Deliverable ounces are quietly evaporating from the supply chain. And when the market finally demands physical metal in size, only one question will matter. Who already has it? Because in a tight market, the institution with metal is not just prepared, it is dominant. It dictates terms, it sets price. It becomes the center of gravity when everything else starts to crack. Institutional hoarding is not a theory, it's a signal. And signals like this do not appear in calm markets. They appear before the storm. All complex systems have warning signs before they fail. Silver is no different. The fractures appear first in the plumbing, in the exchanges, in the delivery system, in the premiums, in the timing. You can see the stress if you know where to look. Start with future spreads. Normal markets show calm forward pricing. But stressed markets show distortions, backwardation, sudden spikes, strange premiums. Then look at delivery delays. Bars that once moved instantly now face waiting periods. Mints reports shortages, refiners overflow with demand. Then the vaults. Inventories dip. Registered metal falls. Eligible piles rise. The deliverable pool shrinks. Then the premiums. Physical shops raise prices. Online dealers sell out. Industrial users complain about sourcing timelines. Lease rates jump. Borrowing metal becomes expensive. And then, sometimes the system itself glitches. Trading halts, exchange outages, sudden freezes, unexpected volatility during downtime. Every fracture whispers the same story. The paper market is struggling to represent the physical one. For years, the fracture stayed small, contained, manageable. Futures smoothed volatility. Liquidity masked stress. Rules kept the machinery running, but no system can absorb imbalance forever. When too much pressure builds, fractures widen. When deliverable supply shrinks, spreads warp. When industrial demand rises, premiums spike. When institutions hoard metal, liquidity dries. And when all of these forces collide at once, the fracture becomes a break. Most markets collapse suddenly. Slow, slow, slow. Then, all at once, silver is not immune. The fracture phase is the most dangerous stage, not because the system has failed, but because it hasn't failed yet. It still looks functional, still looks stable, still looks normal. Until the moment it doesn't. Then the repricing begins. Not in weeks, not in days, but in hours. Sometimes minutes. The fracture becomes the spark. And the market becomes something entirely different than the one investors thought they understood. This is where all the pressure converges. All the imbalance. All the hidden stress. Every great market shift has a trigger. A moment where the system must choose between stability and reality. For silver, that trigger could come from anywhere. It could be a simple policy decision, a rate move, a liquidity injection, a tightening signal. Markets react instantly. Dollar strength shifts. Bond yields adjust. Inflation expectations rise or fall, and suddenly precious metals move. Or the trigger might come from industry. A major solar producer locking in a huge order. An auto giant revealing a new EV lineup with doubled silver usage. A tech breakthrough that multiplies demand. Or it could come from geopolitics. Supply routes disrupted. Export controls imposed. A conflict cutting off critical mines. Or from the exchanges themselves. A surprise halt. Delivery failures. A shocking vault update. A new rule that changes how much physical metal supports paper contracts. But sometimes the trigger is quiet. Almost invisible. A dealer sells out. A refinery goes offline. A national mint suspends production. A bank buys a suspicious amount of metal. And then the chain reaction begins. Traders rush to cover shorts. Investors scramble for physical. Industrial buyers panic and stockpile. Exchanges tighten requirements. Premiums explode. Delivery timelines stretch. Paper claims pile up. Confidence evaporates. The price doesn't climb, it jumps. Gaps. Surges. A silver market running from shortage is not a normal market. It's a revaluation event. People watching charts think they're seeing speculation. They're not. They're seeing a system rewriting itself in real time. Because once physical supply becomes the arbiter of truth, paper pricing dies. And when that happens, silver does not ask permission to move. It breaks free. This is not fear. This is mechanics. The natural consequence of decades of imbalance. The trigger is coming. Maybe from the Fed, maybe from industry, maybe from a vault, maybe from somewhere nobody expects. But every indicator says the same thing. The system is one event away from revealing the true price of silver. And when it happens, few will be ready. Even fewer will understand. Until it's already too late. You've seen the cracks. You've seen the pressure. And you've seen how fast these markets can rewrite themselves. The only thing left is your decision. You can watch this unfold from a distance. Or you can prepare while the window is still open. If you found value in this breakdown, subscribe. Not for hype, but for truth, data, and signals most people never see until it's too late. This channel doesn't predict the future. It reveals the parts you were never meant to notice. Stay sharp, stay aware, and I'll see you in the next one.